Welcome back, everyone. So, if you're looking to navigate what is arguably the most explosive financial shift of our generation, you are in exactly the right place. Today, we're unpacking how to actually invest in the artificial intelligence revolution. Now, let's be real, the stakes here are incredibly high. AI is fundamentally transforming industries at a pace we've frankly never seen before. But with that massive potential comes extreme volatility, terrifying concentration risk, and the downright agonizing pressure of trying to pick the right winners. You want to capture the upside of this once-in-a-lifetime megatrend, right? But you definitely don't want to get wiped out by one wrong bet. So in this explainer, we're breaking down your two main paths forward: exchange-traded funds, or ETFs, versus picking individual AI stocks. Okay, let's dive into this with a number that should honestly just stop you in your tracks. $800 billion. The global AI market is absolutely exploding. While projections do vary, even conservative estimates show this market skyrocketing from a recent baseline of around $200 billion all the way to over $800 billion by 2030. That is a staggering, dynamic leap in a really short amount of time. And frankly, some forecasts are even pointing to $1.8 trillion by the early 2030s. We are talking about a massive macroeconomic shift cementing itself as a growing slice of global GDP. This isn't just a trend, it's a structural transformation of the entire world economy. So, here's our roadmap for today. First, we'll cover the AI megatrend, then the high stakes of individual stocks, followed by the broad exposure of AI ETFs. We'll compare the core metrics head-to-head, and finally wrap things up with a smarter investing strategy. All right, part one, the AI megatrend. It's absolutely crucial to understand the sheer scale of the opportunity before deciding how to invest in it. We need to remember that AI is not just a passing fad. We're looking at projected compound annual growth rates hitting anywhere from 25 to 36%. Sustaining that level of growth over multiple years is just staggering. And what's really vital to understand here is that these massive growth rates don't just apply to one tiny niche area. They're happening across the entire technology stack, from the physical hardware and semiconductors that power the computing, all the way to the software, the cloud services, and the end-user applications. The ecosystem is expanding so incredibly fast. We're talking about data centers consuming massive amounts of power and semiconductors enabling training and inference on a global scale. We're seeing robotics automating labor and highly specialized software optimizing everything from healthcare diagnostics to financial modeling. And behind all of this, you have the hyperscaler giants, the massive cloud providers like Microsoft, Google, and Amazon, pouring hundreds of billions of dollars into AI infrastructure. The demand for AI chips, memory, networking, and power solutions remains incredibly robust. Basically, the pie is getting massive, very quickly. Moving on to part two, individual stocks and the high stakes involved. For a lot of investors, the temptation to single stock pick is just overwhelming. And it makes sense when you look at the dominance of these AI stars. NVIDIA is the undisputed leader in AI GPUs, commanding super high gross margins and projecting explosive 40 to 70% plus growth in key segments. Then you have TSMC acting as the foundry backbone for the entire industry. Broadcom dominates custom networking chips and ASICs, which, by the way, are specialized circuits custom-built for specific AI tasks, while AMD and Micron surge in the memory space. Catching lightning in a bottle with one of these tech giants early on, that has delivered genuinely life-changing asymmetric upside for some investors. It's incredibly thrilling to think about. But we really have to contrast that massive potential reward against the risk. The trade-off for asymmetric upside is extreme concentration. It's kind of like a giant game of Jenga. A single point of failure can wipe out years of gains. Think about it. NVIDIA alone has driven so much of the recent tech rally. If a company like that misses just one earnings cycle, or if a competitive shift happens, like say those massive cloud providers successfully migrating to their own custom chips, you could see a sharp, terrifying drawdown in your portfolio. The entire structure just becomes completely unstable. And then, let's not forget the human element here, the research burden and the emotional toll. To successfully pick individual AI stocks, you need a deep, continuous understanding of incredibly complex tech roadmaps. You have to constantly monitor geopolitics, like the Taiwan risk for TSMC. You have to track energy constraints and regulatory hurdles. And emotionally, it's just exhausting. Most retail investors inevitably fall victim to FOMO, the fear of missing out. They buy high when the hype peaks and then sell low during brutal corrections. Plus, trying to manually diversify your AI bets with just 5 to 10 hand-picked stocks, it's incredibly difficult and overwhelmingly time-consuming. Which perfectly tees up part three, AI ETFs and broad exposure. Think of ETFs as your shield. It's a mechanism designed to capture the upside of the AI megatrend while heavily defending against the heartache of single stock implosions. A prime example of this is AIQ, the Global X Artificial Intelligence and Technology ETF. This is a massive fund with over $10 billion in assets under management. For an expense ratio of 0.68%, it tracks between 50 and 85 companies that are developing or directly benefiting from AI and big data. This means you are getting targeted, yet highly diversified professional exposure all through a single ticker symbol. And here's how that protection actually plays out in reality. The top 10 holdings in a fund like AIQ typically make up only about 35% of the entire fund. The remaining 65% is spread out across dozens of other companies. That instant diversification completely protects you as the investor from any single company imploding. If one stock drops, the other 80-plus companies act as a powerful buffer to just absorb the shock. The perks of this basket approach are basically undeniable. You get instant diversification across the entire tech stack. You get professional index selection and semi-annual rebalancing, which means the fund automatically captures emerging leaders without you having to do any of that late-night homework. You also get much lower volatility. AIQ's beta, which is a metric used to measure a stock's volatility compared to the overall market, is around 1.5 to 1.6, making it a far smoother ride than holding an individual volatile name. Most importantly, as the market grows toward that $800 billion mark, the basket benefits from multiple winners. Even if NVIDIA's growth slows down a bit, memory, networking, or software application stocks inside the ETF can easily pick up the slack. All right, part 4, comparing the metrics. It is time for a head-to-head analysis. When you look at valuations, individual leaders trade at absolute premium pricing and carry immense execution risk. But ETFs, they offer blended valuations. Because they mix the high flyers with more established names, you get a much better risk-adjusted entry point. Now, regarding dividends, pure growth individual stocks yield virtually nothing, often sitting between 0.03 and 0.5%. ETFs, on the other hand, by holding broader tech components, can actually offer moderate yields up to 0.9%, which allows for powerful dividend reinvestment over time. And finally, the risks. Individual stocks present high volatility and the constant looming threat of permanent capital loss. ETFs do carry sector concentration risk. I mean, if the tech sector drops, the ETF drops. But over the long term, that volatility is heavily smoothed out because no single failure tanks your entire position. And that leads us to our final section, Part 5, the smarter investing strategy. So what's the bottom line? We've synthesized the data, we clearly understand the incredible growth potential, and we see the wildly contrasting risk profiles. The verdict basically comes down to this. Unless you are a full-time professional with deep domain expertise, superior information, iron discipline, and an incredibly high risk tolerance, AI ETFs are simply superior for capturing the AI boom. Historical data consistently shows that most active stock pickers underperform the index over time. Why fight that statistic in literally one of the most complex, competitive sectors in the world? ETFs deliver the historical and projected growth you want without the constant heartache. They actually allow you to sleep better at night. Let's turn this from theory into an actual, actionable playbook derived right from the research. Step 1. Allocate 5 to 15% of your total portfolio to AI ETFs depending on your personal risk tolerance. Combine it with a core S&P 500 or total market holding for overall balance. Step 2. Dollar cost average. This means you invest a set amount every single month into the position. Doing this totally prevents you from trying to perfectly time the market. And step 3. Rebalance annually, just to ensure your portfolio doesn't become way too over-concentrated as time goes on. Always remember, you're not settling for lower returns here. It's about intelligent positioning. The winners in the artificial intelligence revolution will be many, not just 1 or 2 companies. By using ETFs, you effectively own the entire ecosystem. Now, if you have super high conviction, picking an individual stock like NVIDIA or TSMC is perfectly fine. But treat it as a small satellite bet orbiting the outer edges of your portfolio. Your core AI strategy, that strong gravitational foundation in the center, should absolutely be built on ETFs. And that brings us to the end of this explainer. The AI revolution is just getting started, and how you choose to participate right now will shape your financial future. I want to leave you with a provocative question to chew on. Based on everything we've covered today, are you team ETF or are you team individual AI stocks? And honestly, more importantly, why? Take a real look at your own portfolio strategy, consult a financial advisor, and decide how you want to ride history's greatest technological shift. Thanks for joining me for this explainer. Keep learning, stay focused, and I'll catch you next time.